Equities and bond markets have been mired in uncertainty as global central banks turn off liquidity taps even as they stare at feeble economic growth due to the Ukraine-Russia war. After 3 months into the new calendar year, returns from domestic benchmark indices remain nil. Globally, the benchmark indices in Japan, China, the US, the UK, Russia, and Europe have given negative returns between 7 and 31%. In the money market, the 10-year US bond yields have inched up over 70% so far this year, while domestic yields have hardened 11.5%. A rise in bond yields indicates losses on the bonds an investor already owns, and the road ahead isn't getting easier. According to analysts, the problem for equity investors is they are unclear where the peak in inflation is. Fixed income or bond markets, on the other hand, fear that aggressive monetary policy will hit the economy, animal spirits, and consumer demand. As pointed out by Akash Prakash in a Business Standard opinion piece, we are entering a dangerous phase for the US economy and market. If the US yield curve inversion remains for 90 days, the US markets go into a significant decline. Equity markets globally will struggle till differentiation sets in and the fundamentals prevail again. Back home, the RBI's Monetary Policy Committee retained its accommodative stance, but changed the wording to remain accommodative while focusing on withdrawal of accommodation to ensure that inflation remains within the target going forward. This, analysts say, hints that the RBI will likely change its policy stance to neutral in the June MPC meeting, setting the stage for a short rate hiking cycle in the second half of 2022. Against this backdrop, where should investors park their money in a rising interest rate scenario?
In this rising interest rate scenario, it makes sense for investors to move some money to fixed income investment, preferably to dynamic bond funds. But it is important to appreciate the fact that even after the expected 2 rate hikes this financial year, real returns from fixed income will continue to be negative since inflation is projected at 5.7%. Equity can beat returns from fixed income in financial 23. So investors should give more priority and higher weightage to segments like IT, pharmaceuticals, chemicals, metals and telecom, which are unlikely to be impacted by rising inflation and rising interest rates.
Vijay Kumar also says financials may also perform well in FY23 as rising interest rates will support interest income. However, if someone is risk averse and prefers debt market over equities, Sunil Subramaniam suggests investing in floating interest rate linked bond schemes.
From a fixed income investment perspective, I would say that there are, first of all, 2 types of fixed income. One is where you park the money for the short term, and second is when you're actually doing an asset allocation and investing for the long term. So when you're investing for the long term, the 2 aspects to keep in mind are what is the ultimate horizon in your mind, and that the tax generally insists that there's a 3-year holding period for investments. So in that scenario, with let's say a 3+ year outlook, if you were to take a 3-year investment horizon in any paper which has a 3-year duration, like medium-term funds and long-term funds, then you would tend to suffer losses there because of the mark-to-market action of a rising interest rate scenario. So my recommendation would be that you stick to a floating rate kind of fund, which will be able to reprice its investments every 3 to 4 or 5 months, so that as interest rates rise, they will be able to participate. Alternatively, you can also use the liquids schemes such as ultra short term, low duration, money market, overnight and money fund, which essentially have a very short duration. Now, initially you might get a low interest rate there, but as the economy's interest rates start rising, they will also be repricing their investments at a higher yield. So even in a liquid scheme, if you stay invest for 3 years, that will be more beneficial than investing in a medium-term bond fund.
Clearly, markets are in for a wild ride till inflation scenario becomes clearer and the Ukraine-Russia war ends with a mutually agreeable solution. Given this, the movement in bond yields will dictate equity markets globally in the near term. On Wednesday, markets will react to the retail inflation data of India and the US and will track Q4 result of IT major Infosys.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.